Hello everyone, the market volatility for the first 3 months of the year is pure madness. And if you are a long-term investor and have only started investing last year, it is very likely your portfolio is in the red. Worse still, many people are saying or predicting that a recession is coming. So in this video, I will discuss on how will recession affect the stock market. I will also share my thoughts on what to do with the red portfolios, and more importantly, to spread some positivity. But before I dive into the details, as usual, hope you can help with the YouTube algorithm by liking this video. Your little support means a lot to me. Alright, so is recession really coming, or are we already in one? Let's take a step back and look at the things around us. US has been hit with the highest inflation in 40 years, rising interest rate, potential inverted yield curve, supply chain issues, stagflation, depression, and the ongoing pandemic and war. All these events will slow down economic activities, and therefore it seems like recession is more and more likely. The market is very fearful now, and I'm sure some of you are as well, especially when so many news articles, financial gurus, YouTubers are talking about the looming recession and stock market crashing. Though the earlier mentioned events are facts, the world is currently filled with so much negativity. Therefore, I hope this video can bring about some positivity. First of all, we need to understand that stock prices are influenced by many factors, both micro and macro. One key factor is actually the strength or weakness of the underlying economy. So when the economy is strong, companies and consumer spending increase, and thus businesses have more profits, which brings about higher stock price. On the other hand, when the economy is weak, everything is the opposite. Spending declines, profits reduced, and as a result, stock prices fall. Alright, say recession is really around the corner. Let's take a look at how do stock markets react to recessions. Since the 1940s, we had about 12 recessions. The latest one is due to COVID at around March 2020, which is not reflected in this table. And that lasted only about 2 months, and is by far the shortest. So that's good news number one. Recession can be short-lived. The other good news is, if you look at the table carefully, the longest recession has not gone beyond 18 months yet. So it's actually not that bad. And one more good news, that is, the S&P 500 usually generates positive returns post-recession. As you can see from this table, the average return for 5 years after the recession is a whopping 120%. And here's another table showing the massive recovery and upside after each bear market. To highlight, the stock market typically declines quite a fair bit for a couple of months during a recession. It usually bottoms out approximately 6 months into the recession and then starts to rally before the economy picks up. So it seems like one just need to, number one, identify recession. Secondly, wait for 6 months. And then finally go all in and wait for the market to rise. Well, I wish it's as easy as that 1, 2, 3 steps. I mean, here's the catch. Most people won't know we are in recession until it's too late, as the GDP data are delayed. Interestingly, stock markets drop before a recession, as the market is forward-looking. So likewise, the market tends to go up before you know it. Therefore, my personal view is, when the market is already down by a fair bit, like now, which it has been down for a couple of months, it could be the time to DCA into fundamentally strong stocks. Take for example, the current market is fearful in recent weeks, and almost every investor and their dogs were shorting the market in the past weeks. And guess what? The market rallied the last 3 days. So now the question is, will it last? To me, it doesn't really matter because I am a long-term investor. So the strategy is just buy into this fearful period, which brings me to this quote by Warren Buffett. Buy or be greedy when others are fearful. And again, the actual action plan really depends on your age, risk tolerance, and financial goals. Take for example, if you are young and or have spare money lying around that you don't need in the next 5 to 7 years, you can then buy the dip. As shared earlier, the economy will eventually pick up, and so do the stock prices. Just take a look at the stock prices now versus 2021. And take for example Tesla or Apple, they are relatively cheap now. So it could be the time to shop for your favorite stocks that are on massive sale. Do it especially if you are young and have a longer time horizon. Next, personally I think the current time is a too late to sell scenario. If you are invested in some of the high-flying growth stocks last year, most of them have been massacred and are down by more than 30-50%. Even for giant companies like Apple and Microsoft, they are down too. So since your portfolio is in the red, why not just hold it out? I mean, the world is still moving towards EV and Tesla is still making cars. People are still buying iPhones, but maybe the cheaper version. Businesses still use cloud services from Amazon, and we are still watching videos on YouTube, which means advertisers are still advertising, just maybe lesser budget. Well, I mean, you get the drift. Fundamentally strong companies will not collapse because of recession. But I can't speak for those unprofitable ones. Lastly, we all know it's painful to sell stocks at loss, but I think it's never too late to sell a poor company stock. For example, Grab. If you have a few $1,000s stuck in there, you may want to cut loss in the next relief rally or bounce up, or maybe now, and perhaps reinvest the money in better stocks to ride the uptrend later. Separately, if you are reaching or in your retirement age, then you may want to set up stop loss for stocks that you have bought say 5 years ago and are still green. So take whatever profits you have and re-enter when the market stabilizes. Finally, what exactly to do during a choppy market also depends on your investment and trading style. If you are a trader, you can make money whether the market is going up or down as you ride with the trend. Some investors also like to hedge their portfolio during bear market through options. Here are my end thoughts. Investing during recession is likely to have high probability of profitability. But the caveat is, during this period, it's better not to buy stocks on margin. Do it when the market is on a strong bull run like last year and not a choppy year like this year. There is always light at the end of the tunnel. Just like COVID, SARS, 911 or other geopolitical conflicts, all these negative events will eventually come to an end. It's just a matter of time. And please remember, hindsight is always 20/20. When the market goes up later, you will regret for not purchasing those discounted stocks. And as I am recording this video, the market has rallied aggressively the last few days. So the point is, just stay invested via DCA because even God can't beat dollar cost averaging. And I shall end off this video with a funny quote I saw the other day. It's a recession when your neighbor loses his job, and it's a depression when you lose yours. So end of the day, just be contented with what you have. Alright, that's all for this video. Hope it's useful in calming your nerves in this choppy market. If so, do let me know in the comments section below. And lastly, thanks for watching my video. Hope you can like, share and subscribe to my channel to show a little support. Thank you.